In the realm of financial reporting, a common set of accounting standards is crucial for transparency, comparability, and informed decision-making. These standards ensure that financial statements are prepared consistently, allowing stakeholders to make well-informed decisions based on reliable and comparable data. Two prominent accounting frameworks that have shaped global financial reporting are UK Generally Accepted Accounting Practice, or UK GAAP, and International Financial Reporting Standards, also known as IFRS. Both frameworks have their unique characteristics and have been developed to meet the needs of different stakeholders in the financial reporting ecosystem. Understanding the nuances between these two standards is paramount for businesses operating internationally or seeking to access global capital markets. The ability to navigate these differences can significantly impact a company's financial strategy and reporting outcomes. This essay delves into the key differences between UK GAAP and IFRS, providing a comprehensive analysis for financial professionals and a clear understanding for a wider audience. By exploring these differences, we aim to shed light on how each framework influences financial reporting and decision-making processes. UK GAAP and IFRS serve as comprehensive sets of accounting principles, guidelines, and interpretations that govern how companies prepare and present their financial statements. These frameworks are designed to ensure that financial information is presented in a manner that is both accurate and useful to users of financial statements. While both frameworks share the common goal of providing a fair and accurate representation of a company's financial position, performance, and cash flows, they differ in their specific requirements and principles. These differences can arise from variations in the underlying accounting concepts, measurement bases, and disclosure requirements. These differences can have a significant impact on a company's reported financial results, making it essential for stakeholders to comprehend the implications of each standard. For instance, the way revenue is recognized under each framework can lead to different financial outcomes, affecting key performance indicators and financial ratios. This exploration into the differences between UK GAAP and IFRS will cover a range of key areas, including the presentation of financial statements, revenue recognition, treatment of financial instruments, lease accounting, accounting for investment properties, and more. Each of these areas has its own set of rules and guidelines that can influence how financial information is reported. Recognition and measurement of intangible assets and development costs, and disclosure requirements. Understanding these specific areas is crucial for ensuring that financial statements are prepared in accordance with the relevant standards and provide a true and fair view of the company's financial position. By understanding these differences, businesses can make informed decisions regarding their accounting policies and ensure compliance with the relevant reporting framework. This knowledge is not only important for financial reporting, but also for strategic planning, risk management, and stakeholder communication. Whether you are a seasoned financial professional or new to the world of accounting standards, this comparative analysis of UK GAAP and IFRS will equip you with the knowledge needed to navigate the complexities of international financial reporting. With this understanding, you will be better prepared to address the challenges and opportunities that arise in the global financial landscape. UK GAAP, or Generally Accepted Accounting Principles in the United Kingdom, has its roots deeply embedded in the long-standing accounting practices developed over centuries in the UK. These practices have been shaped by the unique economic, legal, and cultural environment of the country. Over the years, UK GAAP evolved through a combination of legislative requirements, pronouncements by accounting bodies, and common law. This evolution was driven by the need to provide a reliable framework for financial reporting that could support the growing complexity of business transactions and economic activities. The Companies Act of 1985 played a pivotal role in shaping UK GAAP. This landmark legislation established the framework for accounting and financial reporting, ensuring that companies adhered to consistent and transparent financial practices. It mandated specific accounting principles and disclosure requirements, which provided a foundation for the development of more detailed standards. Subsequently, the UK Accounting Standards Board, or ASB, was formed in 1990 to develop and issue accounting standards known as Financial Reporting Standards, or FRSs. The ASB's mission was to improve the quality of financial reporting by creating standards that were clear, consistent, and reflective of the economic realities of business transactions. In contrast, IFRS, or International Financial Reporting Standards, emerged from the need for a globally unified set of accounting standards. This need was driven by the increasing globalization of business and finance, which required a common language for financial reporting to facilitate cross-border investments and enhance financial transparency. The International Accounting Standards Committee, or IASC, was established in 1973 to develop international accounting standards. The IASC aimed to harmonize accounting practices across different countries, making it easier for investors and companies to compare financial statements and make informed decisions. In 2001, the IASC was replaced by the International Accounting Standards Board, or IASB, which continues to develop and issue IFRSs. The IASB's work has been instrumental in promoting the adoption of high-quality, understandable, and enforceable global accounting standards. The adoption of IFRS has been widespread, with over 140 countries currently requiring or permitting its use for publicly listed companies. This widespread adoption reflects the growing recognition of the benefits of having a single set of global accounting standards, which include improved comparability, increased transparency, and greater investor confidence. The European Union's adoption of IFRS for consolidated financial statements of listed companies in 2005 further accelerated its global acceptance. This move by the EU was a significant milestone in the journey towards global accounting harmonization, as it set a precedent for other regions and countries to follow. While UK GAAP remains an independent set of standards, it has converged with IFRS to a significant extent over the years. This convergence has been driven by the desire to reduce differences between the two sets of standards, making it easier for companies to prepare financial statements that are comparable across different jurisdictions. The ongoing efforts to align UK GAAP with IFRS reflect the broader trend towards global accounting harmonization, which aims to create a more consistent and transparent financial reporting environment worldwide. One of the key differences between UK GAAP and IFRS lies in the presentation of financial statements. IFRS mandates a specific structure for the statement of financial position, also known as the balance sheet, statement of comprehensive income, statement of changes in equity, and statement of cash flows. This standardized format aims to enhance comparability and consistency in financial reporting across different companies and jurisdictions. UK GAAP, while not prescribing a rigid format, provides guidance on the presentation of financial statements. Companies have more flexibility in structuring their financial statements under UK GAAP, which can sometimes lead to variations in presentation. For instance, UK GAAP allows for the presentation of an abridged balance sheet, whereas IFRS requires a more detailed presentation. The differences in presentation requirements can impact the analysis and interpretation of financial statements. For example, the classification of certain items such as deferred tax assets and liabilities can differ under UK GAAP and IFRS, leading to variations in key financial ratios and metrics. Therefore, it's essential for users of financial statements to be aware of these specific accounting standards followed by a company and how they might affect the presentation and interpretation of financial data. Revenue recognition is a fundamental aspect of accounting that directly impacts a company's reported profitability. It determines when and how revenue is recorded in the financial statements, which can significantly influence the perceived financial health of a business. UK GAAP and IFRS differ in their approaches to revenue recognition, particularly for complex transactions involving multiple elements or performance obligations. These differences can affect how companies report their financial performance and can have implications for investors and stakeholders. Under UK GAAP, revenue is generally recognized when it is earned and realized or realizable. This approach focuses on the transfer of risks and rewards associated with ownership. This means that revenue is recognized when the seller has transferred the significant risks and rewards of ownership to the buyer. It is probable that economic benefits will flow to the entity, and the revenue and costs associated with the transaction can be measured reliably. This method ensures that revenue is recorded in a manner that reflects the actual economic activity of the business. IFRS 15, Revenue from Contracts with Customers, outlines a 5-step model for revenue recognition. This model is designed to provide a more consistent and comprehensive framework for recognizing revenue across different industries and transactions. 1. Identify the contract with the customer. This step involves determining the agreement between the parties and ensuring that it creates enforceable rights and obligations. 2. Identify the performance obligations in the contract. This requires identifying the distinct goods or services that the company has promised to deliver to the customer. 3. Determine the transaction price. This involves estimating the amount of consideration the company expects to receive in exchange for transferring the promised goods or services. 4. Allocate the transaction price to the performance obligations in the contract. This step requires allocating the transaction price to each performance obligation based on their relative standalone selling prices. And 5. Recognize revenue when or as the entity satisfies a performance obligation. This means that revenue is recognized as the company fulfills its promises to the customer, either over time or at a point in time. The differences in revenue recognition criteria can lead to variations in the timing and amount of revenue recognized under UK GAAP and IFRS. These variations can impact financial ratios, performance metrics, and ultimately the decision-making process of investors and other stakeholders. For instance, IFRS 15's focus on identifying separate performance obligations may result in revenue being recognized over a longer period compared to UK GAAP. This can provide a more accurate reflection of the company's ongoing performance and obligations to its customers, but it may also lead to more complex accounting and reporting requirements.